So yeah, basically today I'm going to talk about the cognitive biases, and as the session name says, how cognitive biases impact your decision making. First of all, I want to tell you something. What I'm going to talk about today, which is the cognitive biases, doesn't actually only concern traders. It's something that's in the human mind. And as the session moves on, we will know how this basically affects you on a daily basis, not only in your trading, but in your daily life. So today's session, yeah, of course, it will help you so much in your trading, but also when you get to know those cognitive biases and how they appear in your daily life, you will be able to somehow find this pattern and somehow try to find a solution to make sure that any decision that you make generally in your life, whether it's buying a car, moving to a new house, or whatever, it's not basically affected by any pitfall from the cognitive biases. So I really hope that you find this useful today and you will be able to actually level up your trading game with the better understanding of those biases. First of all, let me just introduce myself really quickly. So my name is Mohannad Yakout. I'm basically from Egypt and I live in Dubai. I'm the Chief Markets Analyst at PU Prime. I've been in the trading industry for 8 years now. 8 years, and my position at the moment is the Chief Markets Analyst at PU Prime. Why am I particularly concerned with trading psychology? Because throughout my career, throughout the previous 8 years, I've worked in many, many brokers. And as the market research analyst or the chief markets analyst at any broker I've worked with, I basically come in a lot of contact with many, many clients. And I've come to realize that basically the number one reason for anyone who loses money in the markets is basically the trading psychology. Yes, you can lose by not having a proper strategy. Yes, you can lose because of the technical or fundamental news or whatever's going on in the markets. Yes, this actually happens. But when we are talking about the most common reason, it's always the trading psychology. And that's why I'm particularly concerned with it because, yeah, we can do webinars or seminars about, strategies, technicals, trend lines, technical indicators, and so on. We will often talk a lot about what's going on in the economy and the fundamental reasons, what's going on with the trade tariffs, Donald Trump, and so on. So, this is actually knowledge that you can find. However, when it comes to the psychology, when it comes to understanding your emotions, when it is just you and the screen, when you're taking that decision, it's really important to know that yes, it's the number one reason for losing money. So that's a quick introduction about myself. I'm a certified financial technician, worked with many, many brokers, hundreds or even let's say thousands of high net worth clients in the MENA region, in Dubai, in Egypt, in many, many countries in the Gulf area. And I'm telling you, most people just lose because of the trading psychology. And that's why I'm concerned with this. And I'm not just trying to come to tell you today that, okay, it's all about fear, it's all about greed, and so on. No, I'm going to take you today into a journey of a little bit more details to understand some, knowledge and science behind how the brain works. Because if you know how your brain works when you're trading, you will know basically that, yes, your human brain sometimes has disadvantages. Sometimes your brain can malfunction. Sometimes it can provide you with an outcome that's not logical because it's just, it is how it is. We will understand this a lot more during this session. Okay. So just to get out or to get this out of our way, what's the trading psychology that we often hear about? Of course, this is, the third day of the trading psychology conference. I'm pretty much confident that you have heard a lot about trading psychology. But yeah, let's add one more definition from my point to what's actually the trading psychology. It's the mental and emotional aspects that influence your decision making process. So you're a trader, you make trading decisions often, whether you are an intraday trader or a long term trader, swing trader, whatever it is. But whenever you are on your trading platform, whether it's on a PC or a laptop, and you're thinking, should I buy or should I sell? You're actually going through the decision making process. This is really important right then, to know that, okay, if I'm making a decision right now, is it being affected by any pitfalls from the trading psychology or not? So understanding how you actually feel will definitely lead to a better decision-making process. So it encompasses the behaviors, thought patterns, and emotions, such as fear, greed, which is commonly known, but add also the overconfidence and anxiety that can impact how traders react to market movements. Okay. You know, let me tell you something. Do you know why I told you that the number one reason for traders losing money in the markets is basically the trading psychology? Because it's something that you can never master, right? I'll tell you something. Think of yourself as you're driving a car, okay? You know how to drive a car. You have a driving license. Maybe you have your own car or cars. You have been driving for 10, 15 years. Does it really mean that, okay, you're an experienced driver right now? You have the papers or the driving license, and you have the experience, and you know how to drive a car. Does it really mean that you can go on driving without sleeping for 4 days? Of course not. Because no matter how experienced you are when you're driving a car, basically, if you are not mentally able to drive a car right now, you most probably might end up crashing, right? So the trading psychology is not something that you learn once or practice once. No, it's something that you'll have to apply again and again, over and over, anytime you are on the charts and trying to reach a decision. As we said, this is the decision-making process. And this is why you can find traders who actually learned a lot about technical analysis. They have the strategy. Traders who learned a lot about fundamental analysis, and they know how the economy works, and so on. But if a trader at the end of the day has all of the technical experience and the fundamental news, he's very aware of what's going on in the world. But when he clicks on that button of buy and sell on the platform, if he's not 100% committed and fully aware of his trading emotions at that point, he might, make the wrong decision just because the cherry on top of the cake was actually missing. So this is what I'm telling you. It's not something that you practice once, but you will have to stick to every time you open your charts. And that's why it's the trader's ability to manage emotions and stay disciplined and make rational decisions. Okay. So it's not just you made one rational decision. Okay. You made a rational decision. You made money on that trade. However, tomorrow, when you're trying to trade, if you are not making a rational decision based on all of the information that you have in the markets, you will again, be affected by your trading psychology, and you will end up losing money. And that's why it's, again, a continuing process, again and again, every day. Without the right psychological mindset, even the best strategies can fail due to impulsive decisions. Again, let's go back to the example of you driving a car. Let's give an example. What's the most popular or common car, or the most famous car for providing you the best safety in the world? Give me a name. Maybe, are we talking Volvo? I'm not sure. Not really a car guy. But I think Volvo is the best known, car manufacturer for providing all of the safety and so on. If a car provides you all of the safety, many, many airbags, a lot of technical systems that provide with, any early collision alert and so on. Again, if you are still driving carelessly, you can still crash the car, with all the respect to the safety that it provides. And that's what I'm telling you. Even the best strategies, even the best risk management, even the best everything that you can learn in markets can fail due to impulsive decisions. If you take an impulsive decision to buy or to sell without relying on, your technical strategy, or even if you actually relied on your technical strategy, but you are not so committed to understanding your emotions at that point, you might fail in that specific, trade or decision that you made. We have impulsive decisions, we have revenge trading, and we have the emotional biases. And that's where we will be spending most of our session today. Understanding trading psychology helps control these emotions, avoid common cognitive traps, and develop a structured approach to trading and long-term success. Why is trading psychology really important? Just let me discuss this quickly before diving right through into the cognitive biases part. So, the understanding the psychological pitfalls is as important as technical and fundamental analysis, because even the best trading strategies can fail. We have already explained that if emotions and biases take control. So, that's number one reason why you really need to understand trading psychology, because even the best strategies can basically fail, leading to poor performance. Number two, it increases your risk in markets. So trading psychology directly impacts performance and risk management. That's why, again, it's not something that you just do once. It's something that you should always be sticking to, committing to. I'm committed that whenever I'm placing a trade in the markets, I'm fully aware of my emotions at that point. Am I scared at the moment? And that's why, I'm taking this decision. Am I a little bit greedy at the moment? Am I overconfident? Because maybe I have won previously or the last 3, 4 trades. So I just think, I'm out of this world and I can just trade on, make positions, run winning positions. So am I overconfident? Am I afraid of losing money? Those emotions and those questions and those biases that will affect you is why you should basically understand a lot of trading psychology. Okay, the previous part was just an introduction. Believe me, you came here for the cognitive biases, and here we are. What are cognitive biases? Before actually saying anything, I will tell you that cognitive biases is your mind outsmarting you, literally. Your mind is sometimes on a power saving mode. You know why? Because you have 5 senses, right? You are awake during the day maybe for 16 hours, roughly. Do you know the amount of data or information that you get exposed to, or basically your mind gets exposed to on a daily basis? So now I'm speaking, I'm in my office, I'm looking to the camera. I have other objects, I have other items. However, just because I'm focused to this camera right now, my mind somehow is blurring everything else, next to me. If I look this way, now I'm not seeing the camera so well. It's blurred, right? This is how your mind sometimes gives more focus to something and blurs the other vision. This is your mind, or in this case, my mind. It's outsmarting me a little bit because it doesn't really need that, to spend a lot of effort. Why should you notice what's beside me at the moment? No, you don't need that. And I don't need this. I just need to focus on the camera right now. So your mind sometimes will neglect a lot of information to let you focus on one specific task. And although in this situation, this is really good to me because it allows me to focus on the task I'm doing, but in other times, it really, misses some important information and gives you something that you shouldn't be really focusing on. So your mind sometimes goes on a power saving mode. You have a lot of information to, digest. So your mind just shuts off some tasks and gives you some others to focus on. It's good and it's powerful in some situations, but when it comes to trading, you really should be aware. Is my mind blocking something out from me that I should be focusing on or not? This is what we will be discovering in the cognitive biases. So, cognitive biases are systematic errors in thinking that distort judgment and decision making. Why? Why does it affect decision making? Because it doesn't really provide you with the full picture. If you have the full picture and you make the wrong decision, Now it's your problem, okay? But normally what will happen is if you have the big picture, rationally, you should make the best decision. But if you don't have the full picture to begin with, sometimes you might end up having a wrong decision because you were deceived into believing that basically you understand the whole theme while you just, you don't have the full picture. You're focusing on tiny details, leaving out other important details. So those biases arise from the brain's tendency to rely on mental shortcuts. Okay. I think we have questions right now. Excuse me, I'll have to leave the questions till the end, okay? So the tendency to rely on mental shortcuts, known as heuristics, which help us process information quickly. Because it will take a lot of time for you to just focus on everything that's surrounding you. A lot of information that you're exposed to, as we said, so your mind just provides you with some sort of, filters to focus on something and then the other thing and so on. So this is basically the cognitive biases. It's a way of how your brain works. I'll tell you something even more. Think of your brain exactly as it is with the case with ChatGPT. By the way, a lot of people say, okay, ChatGPT is not logical. ChatGPT is not something good. It sometimes provides short answers and so on. Let me tell you that if you really know or understand anything about the human brain, ChatGPT is literally the human brain. Why is that? Because you have many models, right? The free, basic, old model, I think it was called ChatGPT 3. When you ask it a question, it will just provide you an answer, okay? It will not be doing any thorough research. Most probably it's not updated and so on. So it gives you the easy way. It doesn't want to spend time answering your question. However, if you go up to the latest model, which is probably paid, so now you're requiring a lot, of efforts from ChatGPT. Like, come on, I need some research, I need updated information, and so on. And sometimes, if you notice, sometimes if you ask a question to ChatGPT, if you give it some old instructions, maybe they will leave out those instructions, right? You will have to go back and remind ChatGPT of, okay, remember those instructions? It will only go and recover those and so on. So your human mind works exactly the same. So the first, let's say, model of our human brain, it's the power saving mode. It doesn't focus so much on what's the task that you're having at the moment. However, if you are aware that you need to gather more information to avoid any cognitive biases that you might have, only then you will start noticing that, okay, we have upgraded to the higher model in your human brain, and let's now focus on the full picture. And this is basically why, if you're not aware how your mind handles information, it just, it's power saving mode. It's the mental shortcut to give you the fastest outcome without spending a lot of energy or effort on this specific task. Why do cognitive biases exist? Okay. The human brain is wired to find patterns, reduce uncertainty, and conserve mental energy. As we said, just power saving mode, conserving mental energy. In trading, where markets are fast moving and complex, traders often make snap judgments based on limited information. And this is exactly what I told you about. So you think that because markets are moving really fast, a lot of updates, a lot of price moves, and you need to make a decision now. But actually, you didn't spend enough time gathering all of the information. So now you only have some limited information. So surely when you take an action or make a decision based upon this limited information that you have, the outcome is not the best. This can sometimes lead to quick profits, right? But it often results in emotional or irrational decisions, such as chasing losses. ignoring contradictory data, or following market trends without analysis. Each one of those is basically a separate cognitive bias that we will be discussing in details. Recognizing and managing these biases is essential for improving trading discipline and making more rational, data-driven decisions. Okay, so those are the takeaways that I want you, if you have a pen and paper, please write them down. Okay, so what are cognitive biases? Again, they are mental shortcuts that can distort judgment and decision making, leading to irrational trading behavior. Number two, they exist because your brain seeks patterns and reduces uncertainty. But in trading, this can result in emotional or flawed decisions because your brain sometimes doesn't provide you with the full information that you need to know, right? Recognizing and managing those biases is basically something you can do. You can recognize and manage them, and it's really key to disciplined training. It helps traders make rational, data-driven choices instead of emotional reactions. So, all what we have said so far is, okay, why do cognitive biases take place? Or why basically traders are affected by their psychology? Simply, it's not because they want to lose money, simply because they are victims of their own brains or minds. Your mind is trying to take a mental shortcut just to provide you with an outcome or a quick decision so you can enter markets or get out of a trade without analyzing the whole situation. So, in this process of trying to reach the quick outcome, just like ChatGPT on the old model, you can get an answer or a decision that's not enough, updated, or sufficient. And in this case, it's an irrational decision in your trading. So those are cognitive biases. They exist because it's the nature of the human mind. Because, I'll tell you what, if it doesn't exist, just think of the amount of information and data that you will have to digest and think about every single second of your existence. It will be something that you cannot tolerate. So your mind it's a clever, smart way in smart method in a way, but sometimes when it's actually you want to reach a good decision in your trading, sometimes might affect your trading and your emotional trading decisions. Okay. If you have a pen and paper right now, please start writing down each and every cognitive bias that we will be discussing in today's session. They are countless, by the way. There are many, many cognitive biases. In today's session, I think I have chosen the top 6 or 7 that affects trading specifically. There are other cognitive biases because, I was not only interested in psychology when it comes to trading, but I'm somehow, someone who's interested with psychology generally. So there are other cognitive biases that doesn't affect trading. It affects your personal life. You can read about this later if you have time. You want to research, you can ask even Google or ChatGPT, what are the cognitive biases that affect me as a person in the daily life? Don't tell it that you're a trader. You will just need to read, as a human being. But today I'm giving you the top biases that affect you when you are on your trading platform trying to reach that decision. Number 1, overconfidence bias. For every bias, by the way, I've tried to make this presentation really fun. So what I've done is, for every bias that we will be discussing, I've included some sort of a clip art or a small symbol for you to remember it. Okay, because at the end of the session, I'll be like doing a really quick quiz for you to make sure that you remember those. Because if you know the cognitive biases, but you don't actually remember them, you will not be able to manage them while trading. Because we have attended a wonderful session by Mohannad today who spoke about the cognitive biases. Let's trade the markets. However, I make a decision and I'm not aware that this decision is influenced by one cognitive bias because I'm not fully aware, or I don't actually memorize them by heart. So, it's something that I really prefer if you remember them always while you're trading. So in order to help you, memorize them, I've added those clip arts. So that's the first one. You can see it's some sort of an egoistic clip art. Why is that? Because it's the overconfidence bias. Overconfidence bias occurs when traders overestimate their ability to predict market movements, leading to excessive risk taking. Okay. This results in overtrading, ignoring risk management principles, or holding onto positions longer than necessary. Tell me, if you have been trading in the markets for more than 1 month, or people who have been trading markets, you surely 100% either felt this overconfidence, or someone of your traders friends or something that actually has this overconfidence while trading. And you know what? I've been in the trading industry for 8 years, right? And I'm a certified financial technician. I've discovered that the more I spend time in markets, the more I become more humble, because I literally believe that markets can do anything at any point of time. So even if I expect markets to go up, I'm never sure that it will go up. It's just a probability. Maybe it will go up with a 60 or 70% probability. Okay. You have technical indicators and you have technical clues, and you try your best to make those tools and indicators and the data that the markets are giving you, you're trying to make sense out of those, tools. But it can never be 100% probability. I can never tell you, okay, today this asset or this, Bitcoin is going up. I can never know what it will actually do, because, as I said, the longer I stay in markets, the more I realize that basically I should be humble. So the overconfidence bias, it's more often felt or experienced by traders who are inexperienced. They suddenly, buy off support and prices move in their direction. So, okay, now they believe they are the kings of the market and they are so overconfident, they will start facing losses by overtrading. Because, of course, if you're overconfident, if you're confident that you can make money in markets anytime, so you just think that this is a printing machine, this is just printing money, right? So you can just trade and trade and trade. Instead of, having profits of, let's say, $100,000 in a month, why not do it in a week? So you overtrade and then you lose. Why? Because you're overconfident. You ignore risk management principles. You're overconfident. You believe anything is possible. So you just, increase your trading volume and, of course, increase your risk. Or you hold onto positions longer than necessary. Okay? Number 2, confirmation bias. Confirmation bias is somehow the other face of the overconfidence bias. Because if I'm overconfident and I'm trading the markets and I tell you gold should move higher, for an example, and it didn't move higher, now I'm biased that I'm bullish, right? And I want gold to give me tools or data that basically it will continue moving higher. So when I open the charts and I will now start, experiencing the confirmation bias, I will only look for indicators, tools, technical, statistics or whatever that confirms my direction. Your mind somehow, this is when your mind starts tricking you, right? Because there's a lot of data in markets, a lot of technical tools. You can see hundreds of technical indicators. Your mind somehow will try to filter out any contradictory opinions and only believe those that are on your side, giving you a false confirmation that you are right in markets while you're not. You're on the wrong side of the trade. So this is the confirmation bias. What's the clip art? It's a binoculars. You're trying only to search for data or information that's on your side, that's adding to your belief that gold is going higher, and you just disregard anything else. Or maybe it's not you, but it's your brain, because as we said, this is the malfunction in your thinking process by your brain. Instead of having to analyze all of the data available to you, you just focus on the data that confirms your point or your analysis. So the confirmation bias leads traders to seek out information that supports their existing beliefs while disregarding data that contradicts them. This can cause traders to hold on to losing positions. Why? Because I believe gold will go higher, and it's not going higher right now. But still, I'm suffering from overconfidence bias that we discussed, okay? And I'm suffering from the confirmation bias. I think, or I'm sure that gold will go higher. So I'll just, stay onto the losing position, even if it's, making me lose more and more money, just because I believe it will move higher. And also misinterpret market signals or ignore critical risks. By only focusing on information that aligns with their expectations, traders limit their ability to make objective decisions and adapt to changing market conditions. Well, that's the third one, loss aversion. And the clip art is just, a trader afraid from losing money. What's the loss aversion? When you're trading, you are in a losing position. As long as the position is open, it's actually what we call it is an unrealized loss. You haven't realized this loss yet because the position is still open market. So even if you are losing money now, it's a paper loss. It will be a realized loss once you close this trade. However, once you close this trade, the loss can be irreversible. You cannot reverse this loss. It's done. It's on your account statement, right? So what traders try to do is they don't want to do this. They don't want to close the trade, because once they close this trade, the loss is irreversible. It's in their account statement. You cannot get this money back. However, if the position is still open, they hope that price will go back on in their way and they will recover from this loss. So it's unrealized loss. Traders try their best not to make it a realized loss. In this process, which is, you can say, okay, it's a logical process. Who wants to be having a realized loss that's irreversible? Okay, this might sound rational, but in this process, your mind doesn't tell you that, while it tells you or it shows you that this is the rational decision to do. Like, come on, will you want to close this trade on an unrealized loss and make it irreversible? So, okay, this sounds to you like it's rational. However, this process is the loss aversion bias, because by leaving the trade open, your losses can be multiplied, right? So it's not the rational decision. Your mind makes it look like, okay, that's the best course of action, while it's not. So the loss aversion refers to the tendency to fear losses more than valuing equivalent gains, which often leads to poor risk to reward decisions. Traders influenced by this bias may hold on to losing trades too long, hoping for a reversal. This is why it's called loss aversion, because you're just hoping for a reversal. On the other side, sometimes loss aversion means that you exit winning trades prematurely out of fear of losing profits. On the other hand, when you start making profits, your mind tells you, come on, it's unrealized profit, close it right now. So it can be a realized profit and it can be irreversible. So believe me, your mind is messing up with you. It's telling you to hold on to losing trades in the hope that it will be recovered, while your mind is telling you, come on, just close those profits. Even if it's a small profit, book it in your pockets. It doesn't make sense. You see how your mind is playing out with you? This is, might seem like a rational decision. You're taking out profits and you're just leaving losses to be recovered in markets, but it's not. The best course of action, or the rational course of action, is you close out losers early to make sure that you don't lose a lot of money. And on the other side, you let your runners win to make more profits, to make more money. This is the rational decision. But when you're in markets, your mind can just do crazy things to you. Okay, what's the recency bias? And for you who doesn't know, or maybe he doesn't speak good English, I didn't at the beginning when I was studying this long time ago. I didn't understand the word recency until I knew that it's basically from the word recent. So the recent things mean they are having high recency. So the recency bias, and the clip art here is new. It's basically that your mind is letting you focus only on new updates in markets. Let's say if we're talking today about the US dollar, right? Donald Trump is threatening with tariffs. He imposed tariffs on China, Mexico, Canada, and so on and so forth. So yes, definitely this affects markets. But don't forget that there are a lot of other economic indicators in the US that, of course, affects the market and affects the US dollar. So your mind sometimes will, trick you into believing that it's all about the Donald Trump tariffs right now. So if Donald Trump raised tariffs, just buy the US dollar. Okay, how about the economy? How about inflation? How about the Federal Reserve? How about the FOMC or the Federal Open Market Committee? There are a lot of other information. This is when your mind sometimes will try to save energy, power saving mode, as we said. And in this case, it will just, neglect any other information and just focus on the recent data. This is why it's called recency bias. So it causes traders to give excessive importance to recent market events while ignoring long-term trends and historical data or other data generally. This can lead to impulsive decisions, such as assuming a short-term rally will continue indefinitely or overreacting to recent losses. So I don't want to get into a lot of details. However, if you want to trade the US dollar, let's say, you shouldn't really just focus on the recent data, just focus on everything that's happening generally that could affect the US dollar. Okay? Herd mentality. And this is when someone is just affecting your brain and affecting your decision making, because we can see this a lot, especially today, especially when we have social media everywhere. We have trading communities everywhere. We have groups, channels on Telegram, chats here and there, and so on. So if you see that everyone is buying gold, let's say for an example, but your strategy, your analysis is telling you to short gold, will you actually short? If you short because you believe it will go down, that's the right thing to do. But what most people will do is your brain will try to mess up with you. Okay, do you think you are better than all of those? Everyone is buying gold and you want to sell? Somehow the herd mentality might be opposing to the overconfidence bias, right? Because the overconfidence, you believe that you're the best in the world, you are so good in trading and so on. So this makes you overtrade, makes you fall into a lot of false decisions or wrong decisions and so on. But in this case, the herd mentality, okay, everyone else is buying. Your mind will tell you, okay, don't you see those people? They are good traders. They are all buying together, and you should buy with them. This is when you know that you're just following the trend. You are just with the herd, or being affected by the herd mentality. So it drives traders to follow market trends or the majority opinion without conducting their own analysis. Believe me, if you conduct your own analysis and you short gold, even if it's a loser, it's not really a bad trade. It's a loser, that's fine. But you must know that you are an independent trader. You must do your analysis at any point of time to avoid being affected by the herd mentality. This can contribute to market bubbles. And this is, by the way, this is how market bubbles are formed. Let's say today, me and a couple of my friends, we are crazy enough to buy any meme coin without any fundamental good reason. If we all buy, does it mean that you, as a trader, will now think, okay, everyone is buying this meme coin, I should follow them? This is how bubbles are created. When a bubble happens, it shouldn't necessarily have a reason for it to happen. Just because some people formed some majority and they bought or sold something, other people said, okay, they're all doing the same thing, let's do it with them. That's the herd mentality. And that's why market bubbles happen. Okay. What's the anchoring bias? This is an anchor for a ship. So those symbols, by the way, would be really useful by the end at the last slide when I ask you about them. Anchoring bias occurs when traders rely too heavily on an initial piece of information. What does it mean? Let's say you open a chart, and the first thing you notice on a chart is that prices are moving in an uptrend. Okay, so now your mind doesn't really want to think so much. It's just trying to move in a power saving mode. So what happens is now you will start to think that everything I see should support the upward trend that I see on the charts. You will try somehow to disregard any other information that might tell you that, okay, the trend is reversing or might reverse. It doesn't tell you or doesn't show you that momentum is weakening, let's say, for an example. So you anchor everything you see on that little piece of information your mind saw, which is there's an uptrend. So you're just thinking of buying right now, such as a past price level or a previous market forecast. This is the anchoring bias. By focusing too much on past data, traders may fail to adapt to new market conditions. I think that's the last one. Yeah, that's the gambler's fallacy. What's the gambler's fallacy? It's really simple. You're gambling in the markets, right? It's the mistaken belief that past market movements influence future outcomes, such as assuming a prolonged uptrend must reverse simply because it has lasted a long time. Okay, everyone is buying. I think I should sell. Why? Because I'm gambling. Because I have no clue what I'm doing. It may reverse. It may continue. You didn't basically conduct your own thorough research. But why? Because your mind is on a power saving mode. Why think? Why spend time? Why spend energy? Why, burn calories and thinking when we can just, let's gamble and let's do this. Traders affected by this bias may take counter trend positions based on the expectation of an imminent reversal, rather than sound technical or fundamental analysis. So it's just a gut feeling or an expectation. It isn't really an analysis, right? This often leads to premature or poorly timed trades, which increases the risk of losses. Right. So those are the 7 cognitive biases that we have discussed. What's the first one? This one who feels that he's on top of the world. That's the overconfidence bias. This is why I want you to remember them. Number 2, you're only focusing on limited information that confirms what you actually believe. That's the confirmation bias. Wow, a trader, he's afraid of losing. He has the loss aversion bias. The 4th one, only focusing on new data. That's the recency bias. Someone is being affected by others. This is the herd mentality, right? What's that? It's anchor. So you stick to one piece of information and anchor all of your analysis on that one. So that's the anchoring bias. And the last one, someone's playing gambling. So it's the gambler's fallacy. So those are the top 7 cognitive biases that might and will affect you while trading in markets. And I hope that you will be able to remember them using those ways. Let me end this session briefly by telling you, okay, now we have spotted some malfunctioning in our brains. Our brains doesn't really want to work so much, doesn't want to spend a lot of energy on thinking and diagnosing and analyzing everything around us. How to avoid cognitive biases in trading? Because if I just tell you that there is a problem with your mind and my mind, and I end the session without telling you how to solve it, I haven't really done much, right? So, how to avoid cognitive biases in trading? Number one, you should develop a trading plan. When you know when you enter the market and why you exit the market and when, this is having a structured plan, a trading plan that's clear enough. It reduces emotional decision making, makes it very clear for you. You are structured, you know what you're doing in markets at the moment. Keep a trading journal. And basically, this is one of the advices that as a new trader, I personally never believed. I never understood, why should I have a trading journal and write everything, the entry, the exit? Why did I enter this trade? What was the analysis? Why didn't see markets? And so on. I never believed in the trading journal. I thought that my mind would be able to just remember. Let me tell you that I never made profits in markets unless I had a trading journal myself. Yeah, maybe today I'm not so, I don't journal that much. But the shift from being someone who only lost money in markets to somehow someone who broke even and now, I'm in the profitable phase. This stage, or the transition between the three stages, one of my very good friends was the trading journal. It helped me a lot. Use risk management techniques, setting stop loss levels and managing risk to rewards rationally. If I enter a trade, I know how much I'm risking. I know how much money I'm putting on the table that I might never see come back to me. This is risk management techniques. So far, the three things so far is just being organized. Treat your trading as if it's like a business. I know why I'm here. I know how much I want to make. I know how much I'm risking. I know why I'm trading. I know why I enter this trade or exit, and I keep everything organized and journaled on a piece of paper. So this is just being organized. Believe me, if you do this, 80% of the emotional effect on your trading will just disappear. Seek contrarian views, actively looking at opposing perspectives to avoid confirmation bias. If you are convinced that gold is going higher and it's not going higher, maybe seek out other tools, other analysis. Why isn't it going up? Am I wrong in something? And so on. This is when you actually try to avoid confirmation bias. Mindfulness and emotional awareness, recognizing emotions before they influence decisions. Now, if I'm trading, am I good enough to trade right now? Did I sleep well? Am I hydrated? Am I focused or not? Just like when you are going out to drive, am I good enough to drive or not? Sometimes you can just, take a taxi or something because I cannot drive right now. It's exactly the same. When you're trading, you must ask yourself, am I right now in a good mental state to trade? Am I focused or not? So this is being, mindful of your own self and aware of your emotions. And the last thing is use data and back testing, relying on historical performance rather than gut feelings. If something has an edge when you back test it, it just has an edge and you must follow it regardless of what you feel. And if something doesn't have an edge statistically, again, regardless of what you feel or how your trading psychology is at the moment, it's not just working. So backtesting is really powerful. And again, backtesting can be added to the thing that, being organized when you're trading, using numbers and statistics to assist your trading. So the key takeaways from the session is that biases are natural. It happens a lot, not only in trading, but in your personal life, but can be managed. Awareness and discipline are key to overcoming psychological traps. And a structured approach to trading minimizes emotional decision making. I'm done with my session. I really hope that you have learned something new, even if it was really simple. And I really hope that if you have any questions, please don't hesitate to contact me. You can find my this QR code will take you to all of my personal uh, you know social media, my email, my LinkedIn, and everything. So if you need any question, if there is any way I can help, I'm not coming here to promote anything. I'm not coming to promote any business. I'm just coming here to help you. If there is anything at all that I can help you with or assist you with, please don't hesitate to contact me. Send me a text message. Tell me, okay, I'm struggling with this and that, and I'm here to help you. And by the way, I'm here today because I was in another session maybe 20 days ago. And again, I was helping traders out in an expo in Dubai. So I was approached, okay, we need your help, and I'm here to help. So this is, I find this is, and like, my ultimate goal is to help people and help traders out there reach their financial and trading goals. So again, I cannot stress enough, if you need any help in your trading goals, trading journey, please don't hesitate to contact me. I'll be more than happy to assist you. And thank you so much for being here. And thank you for Tradefulness for inviting me today.
Thank you so much, Mohannad. So you said, oh, it's very simple, but it's extremely important to tell people really simple things and
Yeah,
to make them understand how important those things are. Thank you so much for your expertise. And I have a question to you. So,
sure.
what about your cognitive biases? Did you overcome them? How do you use them? What are your relations with them?
Okay, I'll tell you something. One of the things I still struggle with at the moment is the gambler's fallacy. To be honest, I'm being completely honest. And I've even said this before. Why? Because I'm the chief markets analyst. This is my full time job. So on a daily basis, 8, 9, 10 hours per day, I have my screens in front of me and I just see markets. I see prices. So a lot of times I have this urge or the gut feeling that, okay, I want to sell this right now or I want to buy this right now. This isn't actually based on any sound analysis. It's just because I want to play a little bit with markets. So, but because I'm somehow now aware that I have this issue, I simply prevent it by, creating a new portfolio, small portfolio or a small account with a small amount that I can totally afford to lose without losing a minute of sleep. And I just gamble, I just play. Because if I didn't risk on a small account, I'm, keeping this demon, inside of me and it will come out on a bigger account. So no, I know that I want to gamble sometimes and I want to play sometimes. So do it on a smaller account. So I'm trying somehow not to prevent it, but to make it more controllable on a small account. So yeah, that's one of the things I have.
It's a good point to make friendship with your demons, not to like battle with them, but like to make them.
Exactly. Yes.
Thank you so much. Thank you for these ideas and for your speech. It was brilliant. Thank you for joining us and supporting us.
You're welcome. Thank you so much. Have a great day.
Okay. Well, guys. So